Welcome to Sparta Market Outlook, your go-to source for the latest oil market trends, insights, and strategies. In this podcast, Sparta's team of analysts and experts break down complex market information into actionable, forward-looking insights, helping you make informed decisions in a volatile market. For traders who want to anticipate future pricing trends and seize opportunities before their competition, Sparta provides real-time, actionable market intelligence. For more information about Sparta or to book a demo, visit our website at spartacommodities.com.
So welcome to our second podcast of the year. A year so far has proven pretty interesting from an oil market perspective. I'm your host, Rachel Williams, and this week I'm joined by Phil, John, and Hua. So John was on the pod a few weeks back talking to us about possible US tariffs on Canadian and Mexican crude, and he's back to talk to us today about Cushing and TMX, amongst other things. And we have Hua on the pod for his debut this week, which I'm delighted with. He's our fuel oil commodity owner and is about to launch phase one of Sparta's new fuel oil vertical. So today we're going to put him to the test, talking about fuel oil and everything about Chinese teapots. But look, first guys, did anything happen in the oil markets this week? So Phil, looking at you for this one.
Thank you. I think we all know what the headlines have been. Obviously, these sanctions on the Russian vessels. So let's break it down, figure out what that means and where it's going. At the moment, I think we can fairly say that it's still a pretty fog of uncertainty over everything, but to a degree it looks as though it's undeniable that Russian loadings, crude loadings in particular, are going to be impacted going forward, although maybe less than feared when we were first getting the news. There are going to be a lot of workarounds here. So some Russian oil may or can already be moving under the price cap. We're going to maybe see more vessels being pulled into the dark fleet eventually to replace those that have been newly sanctioned. Mm-hmm. And there's maybe a little bit of slack in that dark fleet anyway.
Yep.
So I think we will expect some volumetric impacts if the sanctions don't get kind of turned around in the first 100 days of Trump's new administration anyway. Maybe Trump even brings in other sanctions, more sanctions, let's see. But let's say 500 kbd of maybe Russian and Iranian flows get taken out with kind of in the medium term with the sanctions impacts. That's still going to be a big signal for price. If we believe some of the banks or the agencies out there that are talking about a potential 2 million barrel a day impact, when if India really does go to zero, then obviously much bigger impact. So in summary, depending on what visible flows do, and we'll look at spot premiums, flat price might end up deflating. Maybe it keeps going. For now, physical spot premium are rising, and with some initial reports that some of those discretionary hedge funds are now very net long.
Yeah, fair. So what do you think? Is crude buy-in reflective of the of diverted buy-in to the legit markets?
Certainly everything we've seen coming out of the Middle East. So the kind of the first supply kind of response is going to be more coming out of the Arab Gulf, and those premiums blew out on Monday. They kept going on Tuesday, yesterday again as well. So Al Shaheen term prices are rising very strongly. And what does that mean? It means that overall those aged crudes going into the Far East, for example, that are now kind of arriving late March, early April, are landing $3.5 more expensive than they were at the start of the year.
Okay,
so it's a big move.
Yeah, no, that's really interesting. So look, EFS and WTI status update. I appreciate we've got John, but just a really quick summary of what has it done to the ARBs, any reversals that we've seen?
Yeah, so it's the Russian sanctions have come at a time when US crude is looking very tight. So the resupply or the backfill in this case doesn't look like it's going to be coming from the US. We'll see. I'll let John talk about that in more detail. But first, it's going to be coming from the Middle East, as we said. Next would be then WAF and European, and maybe the US is the last one to come. So from an EFS side, we should see this reverse back closer to the $1 range. It's obviously blown out a little bit recently because we need that European and WAF crude heading east, it seems.
Fair enough. So OPEC, there may be talk of them potentially backfilling, presumably slowly?
Exactly. So obviously, the market's very interested in the spare capacity of OPEC. It's been theoretically very large for a while. Maybe there's a risk that some of that spare capacity has actually been making its way into the market in reality over the last few months. So we'll see. Maybe there's not quite so much spare capacity as we thought.
Okay, so any upside risk to margin then, Phil?
Yeah, I think overall it should be positive for margins as well, right? There's a risk to Chinese runs, especially the independents there. Juan is going to talk about that in a little bit more detail. Indian runs in particular, obviously very reliant on Russian crude, so we'll see how they respond to the sanctions. And then with the Iranian, Russian, and let's talk about Russian fuel oil as well, Juan. I think there's definitely pressure on the feedstocks, and then maybe also the Russian distillate exports as well. So global cracks looking more probably at diesel, fuel oil, maybe naphtha as well. I think finished gasoline is still a little bit kind of ring fenced away from the upside potential. Those could all rise to bring European runs higher or keep them higher.
Okay, just one thing to note as well, overnight we obviously kind of had the news about Colonial Line 2 kind of going out, potentially bullish for gasoline and distillate. I think at the minute kind of all eyes are obviously on Europe, utilisation rates and what that means. Clearly, I think, Phil, you're writing a snippet at some point.
First response from, using our live arms tables, which is very useful on this. First response seems to be very much distillate focused. So distillate Europe to PAD 1 has already opened. Gasoline is still pretty closed.
Yeah, okay, cool. So to be fair, kind of European slight utilisation is up around kind of the high 70s at the minute. We've got decent inventory to be fair as well. So we've seen TC2 rally. I think we're about 170 now. So as I said, keep an eye on kind of our snippets coming out today for that one. So more importantly, back to the heavy end of the barrel. So why your time to shine? There has been some changes to fuel oil taxes in China over the last couple of months. So putting your fuel oil hat on, what do you think is the effect of those changes? It'd be great to hear your take on this.
Sure, and thank you for having me. It's great to be here. Obviously, there are a couple of things affecting the teapot at the moment, especially when it comes to fuel oil. But I think it's also helpful to give audience or even ourselves a bit of context of exactly the teapot take the fuel oil for and why they do that. So obviously, I'm making quite a number of simplifications here, and the reality is, of course, a lot more complicated, more nuanced than that. But in general, you have two big subsets of teapots in China taking the height of Australia run. Most often, Russian height of Australia run. You have those with and those without crude import quotas. And the first subset of teapots with crude import quotas tend to be on the larger side. They often either plan the height of Australia run into the rest of the crude slate to optimize refinery yields. One is through the secondary unit, your traditional FCC plus coker kind of setup. Yeah. The second subset of teapot, they don't have crude import quotas and they tend to be on the smaller side, maybe a little bit older as well. So these teapots don't have much of a choice and they are dependent on the heights of Australia run or one of the other non-crude alternatives like bitumen mix or, in the past 2 years, this other heavy oil category, which, it could be a lot of things in the world that the government is really trying to phase out. And the distinction is actually quite important because they tend to behave in very different ways and also, they have different relationships with the crude side of the equation. So moving back to the main question, we have seen a few changes in fuel oil tax policy in the last couple of months. Back in Q4, we saw a reduction in the amount of consumption tax rebate that the teapot could claim. And the context for that is that for every ton of fuel oil a teapot imports, they pay, I think, 1,218 yuan in consumption tax upfront. But once they have processed it into clean products like gasoline or diesel, they can claim back a good amount of that. So in the past, we've seen them being able to claim up to 90%, even 95%. So, almost the entire tax that they pay, they were able to claim that back. And so the big change in policy in Q4 effectively kind of restricted the amount they can claim to something closer to I'd say 60 to 75% on, 75%, obviously a little bit more optimistic, sometimes people do have a bit of leeway when it comes to reporting, the receipt of all these clean products. So, and that's basically the amount of clean product use that they get from processing the straight run. And the second change to the tax regime in China in terms of fuel oil, which is actually getting implemented at the moment, involved raising the fuel oil import tariff from 1% to 3%. So it's a 2% jump in terms of tariff. And this is different and separate from the consumption tax that we just talked about. As far as I know, there's no sort of rebate for that. So you just have to pay it. You can't claw it back. So the impact of both changes, both the one in Q4 and the one we're seeing at the moment, is actually in the same direction. And that's effectively raising the cost of obtaining straight-run fuel oil as a feedstock for refining for all of these teapots.
So Juan, just a very quick one, if I may. You talked about a Juan level of consumption tax. Can you translate all of that into a very rough dollar per barrel impact? If not, no worries.
Yeah, sure. So you're talking about, you're paying 1,218 yuan per metric ton in the so-called the consumption tax. So I think that's roughly 150 US dollars per metric ton. So
okay.
You're not getting back, say, 20% of that versus what you were getting back just a few months ago. So that's 20% of that is, easily $30 to $40 per metric ton. And if you do like a, quick 6 to 7 barrels per metric ton kind of conversion, you're talking about, easily $6 per barrel kind of impact just from that alone.
It's extremely significant. Then.
Yeah, that's quite interesting. So look, you touched upon kind of the rising cost of obtaining straight-run fuel oil as a feedstock for the refining side. So how do the teapots or the market usually react to that?
That's a good question. I think that's also what a lot of people are interested in. And I always emphasize look at the teapots as two big subsets with different behavior, as we just talked about. There is a reason for that. If you're one of the bigger teapots with crude import quotas, you do have a bit of recourse to crude as long as you still have your quota, because this is the start of 2025. You do have all the new quota to utilize. So for these teapots, they can look at non-sanctioned crude, which of course tend to be quite a bit more expensive. Some may even look at Russian or Iranian crude barrels, but we have just talked about how the latest and much stricter round of sanctions against Russia and Iran will likely make obtaining either of those a little bit more difficult, at least in a short run. It is a tricky thing, and you have to look at not only the over refining margins, but also kind of like the comparative margins between taking high straight run, taking bitumen mix, or taking crude, either non-sanctioned or sanctioned crude. If you're one of the smaller teapots without crude quotas, you're getting really squeezed here. You don't have much of an alternative to Russian straight run. You don't have recourse to importing crude, obviously. You can look at getting bitumen mix, which is basically a mix of Venezuelan molecules with, a million other things. That comes with its own set of taxes and regulations, which are very different from, like fuel oil, crude, some of the things. In the past, you could look at importing things under the other heavy oil category.
Okay.
But as I said before, the government is really trying to phase that out this year. So overall, that means that, margins for these smaller teapots will get massively squeezed. In the past, we've seen massively negative margins for, long periods of time. You will be looking to minimize runs as much as you can, but if you don't have, contractual obligations in terms of, domestic gas, diesel, etc., you may even want to shut down after a long period of, terrible margins.
That would make sense.
And without going into the complicated domestic, clean demand side of the equation, which is super complicated as well, the natural market reaction to this would be a downward adjustment to the premium on Russian high-sulfur straight run. And that was usually what happened in the last 2 or 3 years. We saw that a couple of times. Premiums often came down, so allow margins to pick up again in order to kickstart demand for importing these barrels. How far down it could fall usually depends on the floor set by the crack pool for bunkering, because that's the next best form for these molecules. If these teapots in China can't take it, then the next best one will be your bunkering pool.
Okay.
So we usually call that process downgrading, because you're shifting, these straight run molecules and usually go into the higher value feedstock home to the lower value bunker pool. But we're talking about anywhere from a few hundred KTs to say 2 million tons a month of these materials, which is relatively large compared to, say 2 million tons of high sulfur bunkering in Singapore and Zhoushan and, off port limit, etc., combined. And in the past, this naturally led to the floor itself moving downward eventually as crack collapsed. So we saw that in 2022, 2023, 2024.
Okay, but we haven't really seen much of that so far, right?
Yeah, you're absolutely right. A 380 is still in backwardation. So it's not, it's also not extraordinarily strong at the moment. Crack is hovering, I think, at about $5 discount Brent, which is fairly strong relative to recent history. It really is a more complicated story, owing to a variety of factors, especially with recent news on the sanctions thing. But first of all, just because there's a fall in teapot demand doesn't immediately mean that all the molecules will instantly get flushed into the crack pool. We often see vessels floating off China for a long time, weeks or even months. Previously, I saw vessels that were staying, like off the coast for like 3 months straight, just floating there, doing nothing. Obviously, part of that also depends on how steep the backwardation is. 380 backwardation has strengthened somewhat from pretty much flat just 2 or 3 weeks ago to, I think, probably $5 or $6 per metric ton now in the front, but it's quite far from the double digits that we saw just a few months back. Second, it takes a much longer time to put, say, 800 kg of Russian high sulfur fuel oil into bunker than the equivalent amount of, say, Mexican high sulfur fuel oil. I usually like to think that 1 million tons of Russian high sulfur oil tends to have less of an impact on pricing compared to, say, just 2 or 3 Suezmaxes of Pemex materials heading to Singapore, because that those Pemex molecules can actually go into window directly.
Yeah.
I think another reason, if you look at, like, even though the latest round of sanctions on a bunch of vessels affected mostly the ships carrying crude recently, it will have a knock-on effect on fuel oil because, as you know, both compete in the same kind of market for dirty Aframaxes and Suezmaxes. So most likely that's going to push rates up, and also making that's going to make landed premiums a bit more expensive as a result as well. And I think, as we also discussed earlier, you've got stricter sanctions on both Russia and Iran. So those would restrict kind of both crude and non-crude alternatives for some of the teapots and make them more expensive. So all of these, 4 things that I just talked about do have count on a natural downward adjustment in the complex, or at least for some time. And and obviously we haven't really talked about another big question mark, which is Venezuela, but let's save that for the podcast.
Absolutely. Well, looking forward to hearing your views on that one. But look, Hua, you talked about how a certain amount of Russian high sulfur straight run may not have much of an impact on pricing as, say, Mexican high sulfur fuel oil. So how do we then understand, the price action on the high sulfur side from a more fundamental perspective?
Well, I think that's a great question. Also, kind of a tough question that a lot of people are trying to answer.
Sorry,
right? So traders tend to still rely a lot on traditional S&D balances, but the high sulfur complex is notoriously tricky, even if you've looked at it for a long time. If you just rely on an over S&D balance that counts everything at a high sulfur, you tend to run into a situation where market moves don't make much sense relative to the fundamentals. I've seen in the past where everybody is like, there's just, the balance, there's a lot of builds in the balance in the coming months, and then the spreads did the exact opposite of what everybody was thinking. So in reality, the high sulfur market should really be thought of as a 2-tier kind of market where you have a so-called legitimate balance comprising of non-sanctioned materials, which is often drawing all the time. You also have a gray area kind of balance comprising of sanctioned materials, which is building most of the time. And then you have the interaction between the two of them. And most often, the direction of the legitimate balance has more of an impact on market pricing than the other balance or the overall balance itself. So the point here is that looking at an overall S&D balance for high sulfur could be, it's quite misleading when you're trying to understand the price action. So you really have to drill down to what exactly, the fundamentals are doing in each specific kind of balance, the non-sanction and the sanction, and also the interaction between the two of them.
Really interesting, Hua. First and foremost, very much looking forward to the fuel oil release and having you back on the podcast in the next couple of weeks for sure, but also kind of starting to write kind of the commentaries as well and the snippets. It sounds like it's going to be pretty eventful kind of. But look, if I was to ask you kind of just to summarize or just highlight kind of what are the 1-2 things that you're keeping a close eye on over the next, say, month or so in the fuel oil markets, what would that be?
Well, I think high silver is pretty interesting at the moment, for the obviously reasons that we just talked about. I think the low silver complex is also, most people kind of think it's a little bit boring at the moment, but I've seen a couple of issues, people have talked about some issues with Malek crude, which has been kind of a significant barrel for blending in Singapore in the last couple of months. I've heard some issues when it comes to flash point with Malek. So the flash point is kind of getting lower, which it might have an impact on blending VLSFO in Singapore. And also, keeping eyes on Dangote barrels as well. So I think low sulfur could turn out to be, a little bit more exciting than people might expect. So
Brilliant. Okay, well, sounds like a good time to have live blender then in that case. Wow, so very much looking forward to your fuel oil launch. And with that, we'll move over to John.
Hey John, how you doing? So moving complete time zones now over to the US, and good morning to you. How's things going?
Hey Rachel, great to be back on the pod. Doing well. How are you?
Yeah, not too bad. Not too bad at all. Okay, so moving on with crude, John. There's been quite a lot of focus on this, especially kind of over the start of this year. Significantly US inventories, specifically Cushing inventories. So can you put your US market analyst hat back on, please, and give us some context in terms of what's happening and what it means to the market at the minute?
Yeah, absolutely. So certainly some very interesting times happening in Cushing, Oklahoma, and we'll dig into the whole situation there. Just to provide a little context, though, the timing around this is actually quite interesting and very relevant for a lot of market themes that I think are going to come out over the next few weeks. As I'm sure Phil might have mentioned earlier on the podcast, talking about Russian sanctions and the fallout of impacts that we've seen on the global crude market. We've seen things like screaming higher time spreads, both for Brent and TI. You've seen freight rates just shoot for the moon in a lot of instances. So you have ARBs kind of moving all over the place, and it's quite interesting. And the natural question that comes up is to say, well, if there is a significant volume impact, how much of that can be backfilled by the U.S.?
Yeah.
And I think this story in Cushing at the moment is direct bullseye center of what people need to be thinking about here. So some context on what's happening in Cushing at the moment. Right now, Cushing inventories as of the latest EIA report from this week. Spoiler, we're recording this on a Thursday, so the latest data point came out yesterday. And Cushing's sitting at about 20.8 million barrels. Now, that number might not mean a lot to most folks, but there is a concept in Cushing of this operational floor where Cushing inventories cannot be drawn down to zero. And there is some theoretical lower bound that is kind of a squishy number. Nobody quite knows what it is, and there's a lot of moving pieces. But it's somewhere right around here, and it's been tested any number of times and always bounced off it. And so right now, with Cushing sitting at basically operational minimums, you cannot continue to draw on Cushing to backfill a lot of supply that U.S. refiners need at the moment, which refiners in the U.S. are running basically flat out, running very hard and much harder year over year. So when you have a situation with Cushing being at operational thresholds, you start to see very interesting things happen to NYMEX WTI futures pricing because Cushing is the physical delivery point and settlement location for these futures contracts. You need physical supply to be there. And if you have a situation where you can't draw any more down to satisfy a lot of these futures contracts, pricing is going to incentivize volumes to come there. The other way to think about that, in addition to incentivizing volumes to move into Cushing, is to incentivize volumes to stop moving out of Cushing and therefore potentially out of the U.S. So the way I've thought about this over time is, when things get very tight in Cushing, you'll see a price-induced shutoff valve put somewhere into the system, whether that's in Cushing pricing, which is your benchmark WTI price, whether that's in U.S. coastal pricing. Think of that as like MEH or a WTI FOB price. Somewhere in there, you're going to see pricing move to retain volumes into the domestic U.S. system.
Okay.
And so it's a very stark dichotomy of what's happening with all the moving pieces happening internationally at the moment, because as the market's trying to sort out rapidly moving freight rates and rapidly moving Middle Eastern FOB prices to settle out this new market dichotomy that's trying to emerge with the massive slew of sanctions on Russian vessels, WTI is also trying to work to shut off marginal flows out of the U.S. to retain these volumes in Cushing. So the way I'm thinking about it is WTI is working aggressively to price itself out of main export markets like Northwest Europe and Asia, to name a few.
Yeah.
But it's struggling to do that because everything else is skyrocketing at the moment as well. So it's a bit of a race to the top as the market in general appears quite jittery about supply tightness. But at the moment, the clear and present danger is in Cushing, Oklahoma, where there is very real and tangible supply tightness. It needs to be addressed immediately. So what you have to see is WTI is going to have to continue to price quite aggressively to help alleviate this Cushing situation. And we can get into some of the specifics that are actually driving this supply tightness in Cushing a little bit later.
Yeah.
But I think the first point to hammer home is that, we've developed a number of internal metrics that we're testing out to assess how expensive or cheap crudes are in export markets. And at the moment, what we're seeing from WTI is that it looks, marginally less competitive than normal, but it's not in any situation where you would say, arbs are definitely closed, which is somewhat of a problem because Cushing has nowhere to go but up. And to do that, you need to reduce outflows out of the U.S. or see U.S. refiner crude runs come down. Now, that's kind of the first consideration. There is a traditional maintenance period for the U.S. that's looming, still more than a month out though. So it's not really something you can rely on to immediately fill Cushing inventories, which is what has to happen at the moment. I think before you can get to that point, you have to see outflows come down. And for that to happen, WTI is just going to have to get a lot less competitive in these export markets, more so than it has. And it's kind of a race to the top, if you will.
Yeah, okay, fair enough. So look, you've given us a bit of colour in terms of what this means kind of right at the near term. I mean, we touched upon kind of very, very early kind of in the podcast about colonial pipeline issues and what that could mean, especially with resupply kind of just on the product side, kind of from Europe and where Europe refinery runs are. Does your real short-term view of this change kind of with colonial, kind of with the issues that we've got on colonial for some of the PAD 2 refineries? And would that help? I know I'm pretty much kind of putting you on the spot here, John, and we will be writing kind of a market snippet on this. But do you have any thoughts on that just on the short term before we kind of move into what does it actually mean kind of on longer term?
Yeah, absolutely. And I think to complement that question, I kind of need to address an underlying theme that has emerged that's driving a lot of this Cushing tightness to help set the stage for that question. And for a lot of the non-North American listeners out there, I'll have to give you a little extra context here, but there's a pipeline in Western Canada that came on last year called the Trans Mountain Expansion. This is a pipeline that moves Western Canadian crude directly to the west coast of Canada and exports to Asia, to West Coast US, that sort of thing.
Yeah.
The knock-on effects from that, though, that's not completely new supply that's moving west. That's pulling supply out of traditional destinations in the U.S. and redirecting it to these other locations. Some of those locations in the U.S. have no other option. Either being PAD 2, you can either run Canadian crude or crude domestically produced crude that probably comes from Cushing. PAD 3 obviously has a little bit more optionality on the waterborne side, but you're still pulling supply out of that needs to be backfilled. So to give you some sense of numbers here, TMX flows into the back half of last year after it came online in May of last year were running somewhere between 400 and 500 KBD, which doesn't sound, hugely massive when you think about the U.S. refining system as, 16 million barrels a day, that sort of thing. But when you think about the micro-targeted redirection that's happening, this ends up being about 200 KBD of reduction of volumes moving into PAD 3 through Cushing. That's 200 KBD, all else equal, that it needs to replace. On top of that, PAD 3 crude runs have been running 500 to 600 kbd harder year on year.
Yeah, it's been pretty staggering, to be fair.
Yeah. So that's a net swing of 600, 700, 800 kbd of volume that has to come from somewhere. And looking at EIA import data, it's not coming from imports.
Okay.
PAD 3 refiners haven't boosted waterborne imports at all. So this means it's coming from domestic supply.
Okay.
And therefore putting an undue strain on Cushing and dragging it down more than it normally would during build periods where it would seasonally build. You're going to see smaller builds, and during draw periods, much more aggressive draws, which has got us into this ultra tight situation. Now, to your point on, how is Colonial potentially going to impact things here? The real question is how much Cushing supply or potential Cushing supply is PAD 3 going to draw? And therefore, what's your view on PAD 3 crude runs going forward? Yeah. Obviously, any outage on Colonial is a main artery of product placement in the PAD 1 for PAD 3 refiners. So any extended issues there is going to significantly impact product balances and therefore PAD 3 crude run incentives. Yeah. Does that mean you see earlier than planned maintenance? Maybe. I don't know. We're not really going to make that call right here. But that's the sort of thing that can help just take the slightest bit of pressure off Cushing when it's at these operational thresholds.
Yeah,
so
it's
certainly.
It's quite interesting though what you say though, because it sounds like there's a bit of a balancing point then between you potentially could get into a situation where PAD 2 start kind of cutting. We're also going into maintenance as well, as you say, but you could end up with PAD 3 actually taking the slack and running a little bit harder, given the fact that it has to be a waterborne trade from there. So that's a really interesting one and one to watch. Look, thinking about it fundamentally over a more kind of just a little bit stretching your horizon out a bit, John, is this kind of only a short-term phenomena that we're actually seeing with Cushing? And you've started to kind of address that anyway. So how do you think fundamental shifts play out over the next 12 to 18 months? And does the market, so our traders and our analysts listening today, any correcting mechanisms to think about kind of from their side?
Yeah, I think that's the real question that should be on most traders' minds here is that, you've got a double-barreled effect here happening where Cushing is ultra tight, and then you've seen this sanction impact drive a lot of tight like jitters from the rest of the market all happening at the same time. There's questions about how the international story will play out and how the supply side there will calm down, but I think the Cushing story is going to be a bit more nuanced. So this TMX effect is redirecting supply away from Cushing, and without any real demand change on the refining side in the U.S., which there's no real indicative reason why U.S. crude runs would cut for a more extended period of time unless you have some sort of demand shock. The lever to watch is going to have to be supply. And that's, that could come from the U.S. It has not shown in recent years, the mammoth growth powerhouse potential that we've seen perhaps 3, 4, 5 years ago, especially pre-COVID. You're much more in the tepid 300, 400 kbd type range. Same thing for Canada. While it's not a rapid growth story like the U.S., they've been a steady grower in that 200 to 300 kbd range. And really, it's a drill to fill story for Canada. That's kind of the nomenclature we hear from producers up there is if there's new pipeline space to fill, we're going to drill to fill that. The challenge is that's a quarters type story, not a weeks or a months.
Yeah. So it's one to watch. Yeah.
Yeah. I mean, absolutely. I think you're going to see a condition where Cushing is just ultimately tighter over the next 12 to 18 months than it would have been had TMX never come into effect. What that means for the market is all else equal, higher WTI prices and lower marginal outflows out of the U.S. as more supply just has to be retained to not only fill U.S. refining appetite, but also to maintain adequate supplies in Cushing. So in a time where the market appears to be getting concerned about waterborne balances and supply tightness there, this is adding a bit of fuel to that fire to where the U.S. is simply not going to be able to come to the rescue and just export to fill any gaps internationally.
Cool. So interesting kind of dynamics going on in the light sweet. Really appreciate your summary there as well in terms of how you view Cushing going forward. Look, John, I ask everyone on the podcast kind of what are the 1 to 2 things that you're looking at over the next week, shall we say? I appreciate next week is a busy one in the US with Trump taking the seat. The first 100 days, I'm sure, are going to be quite interesting to watch as well in terms of sanctions or no sanctions, potentially. And we've talked about that in the past as well. So But what are you really looking at, kind of 1 to 2 things kind of on the crude vertical?
Yeah, no, I think you raised a good one there, and I think we'll frame that as we have a pretty clear signal and a pretty ambiguous signal to talk through. The ambiguous one would be what you just mentioned there, the sanctions of the incoming Trump administration that has been promised endlessly in various forms, that could potentially come through executive orders on day one. There's discussion that Trump is going to look to push 100 executive orders on his first day in office, which there's not a lot of clarity of what that means. Yeah. So there could be 1 week from now, a lot to talk about on that regard. So that's certainly one to watch, but not a lot to discuss on how to trade it at the moment. The one that I think is a little bit more solid and clear at this point is going back to what we talked about with WTI, is that as it seems right now, WTI looks a little bit on the expensive side in maybe most export markets, but not enough to really deter significant volumes, in my opinion. Okay. So you're going to need to see WTI simply get more expensive, less competitive in these markets to really take the air out of export volumes out of the U.S. to address this Cushing situation. So while you have seen a relative move higher for WTI over the last week, I would say look for a lot more of that to come over the next week as WTI continues to have to shut a lot of these incentives to pull it out of the U.S.
Okay. So, all right, one to watch. I will be noting that and we'll track that kind of over the next week. So thanks again, John. Thanks again to Phil and Hua as well. It's always a joy to have you all on the podcast. And I think next week we'll probably kind of move back into kind of the cleans side, unless kind of crude surprises us or continues to surprise us. But very much looking forward to kind of hearing kind of how all of your thoughts and ideas kind of trade over the next week. Many thanks to our listeners as usual, and look forward to presenting to you guys next week.
Thank you for listening, and we hope you enjoyed the podcast. For more information about Sparta or to book a demo, visit our website at spartacommodities.com.